Peace, love, and light, fam. I hope you're having an amazing day. So on today's episode, we're going to talk about interest rates, we're going to talk about recessions, and we're going to talk about the big, most important part of what comes during the end of an economic cycle, or at the end and then the beginning of a new one. This is considered a new world order of a monetary policy. You can also refer to it as the Triffin dilemma, which I've covered in previous videos. So I just want to get right into it. So today, the Fed rose the prime rate 50 basis points, which means that right now we're sitting at about 4.25%, 4.5%, and this is the prime interest rate for all lending. So what does that mean? Okay, so take it back to 2008. After 2008 crisis, 2009, the Fed dropped it down to near zero, and I don't quite understand why there isn't exact numbers. It's always like an estimate, but yes, it was near zero, not my words. Anyway, their words. So what that means is, okay, now interest rates have gone up at the fastest rate in over 40 years because for a good decade, borrowing was really inexpensive. Very cheap in compared to what it is now and what it will be next year and going forward. So it's important to understand that for multiple different reasons. And I always love talking about investing. Obviously, that's kind of the main point of me talking about a lot of these topics. But what's more than that is, okay, so to understand investments, you have to understand what's going on in the world, macroeconomics, like bigger picture. So, all right, so let's take a step back. So now that interest rates are going up, what does that mean for you, the average person? Well, they're doing this because at first you have inflation that gets higher and higher and higher, meaning the cost of goods and services are increasing, which is another way of saying that the value of the dollar is going down because it takes more dollars to buy less goods. Okay, so now that we've seen that, they try to fight this. The Fed tries to fight it because the Fed is like the entity that's in charge of keeping the dollar strong and it's protecting the citizens, so they say. Anyway, to try to counteract inflation, they raise interest rates, even though this issue was kind of a demand. It was a supply rather than a demand issue. When you have a demand issue, inflation, it's because everyone's just spending. Spending. There's a lot of spending going on, and there is a lot of spending going on, but a lot of the issue is this inflation was set based upon the shortage of goods and services that were available because of the economic supply chain collapse that happened from 2019, and then COVID happened. So then you have that. Okay, so now we understand that. So typically what the Fed will do is tighten policy. So what that means is they're going to, one, try to shrink their own balance sheets, which I'll explain a little later. And this is all kind of boring stuff, but it's super important to know, and you'll find out why by the end of this video. So for the Fed to actually successfully decrease the inflation, a lot of times it's spending. So what they'll do is tighten policy. Mortgages will go up, credit cards will go up, and this is the basis of all spending. So all the car notes and all of the stuff that you need to borrow money for, people won't do that as much because it's going to cost them more money to borrow from the bank. All right, now he said this, but we also talked about this being a supply chain issue. So this being a supply chain issue, the reason people are spending is because they can't get enough of the goods and service they get, and by the time they're actually able to get them, they buy in excess. In addition to what I saw on Bloomberg was that a lot of the millennials that are living home with their parents and don't have that overhead of rent expense or mortgage, they have that extra capital to invest or to spend. More than likely, they've been spending it, and they're tracking that a lot of things have been spent on luxury goods. Okay, not to get too far from the point, but what I'm saying is these points in time are extremely valuable to pay attention to because we see major changes happening. And like I said, supply chain is going through renovation. We have the financial sector that's going through major renovations. You see they're launching CBDCs literally all over the world. The entire world is about to go into a global depression, which is something that doesn't happen very often. highly encourage you study and just do some homework on debt cycles and financial crashes. I actually have a few here that I want to share with you just over the past 100 years. So that being said, I want to do that. So first and foremost, let me find the right page. So we have the bank rescue of 1907. And trust me when I say I'm going to bring all of this into perspective. 1907 is when you had some insurance issues out in Cali. Then you had the Knickerbocker Trust Company go bust. So what happened was JP Morgan actually had to bail out the government in this case. Okay, so the New York Stock Exchange, and they decided to go to JP Morgan, which is JP Morgan Chase, and catch a loan from him, which is crazy to think at the time. Imagine, the government going to Elon Musk or that French guy. Oh, I guess he's not, because Elon Musk just got passed today. As Tesla stock goes down, another guy came up, the head of Dior and all those other luxury brands. Anyway, then you had the price tailspin of the 20s, and then you had the actual stock market crash of 1929, which is part of the Great Depression. And then there was a secondary crash in, I think, 34. That's kind of why I call it Great Recession. Then back again, to bring this in perspective, skip a few chapters. Now there's these collapses that happen, and again, they happen every 9 years, give or take, where you have some sort of major market correction. Some greater than others. We're going to really talk about the big ones. So that's why we're skipping to 1980. So when the head of the Fed at the time was Paul Volcker, and he had to fight very high inflation from the 70s. After Nixon got off the gold standard, they were just printing money left, right, and center. So then you have this huge bubble in the late 70s, early 80s. So Volcker had to tighten. Now, this is the last time we've had this aggressive of a Fed rate hike, and that's the same thing that's going on now. So it's also important to mention this stagflation, which is exactly what we have going on now, resulted in a national energy crisis, which is, I don't want to spell this out for you because you see what's going on with Russia, China, India right now. Russia's selling a lot of their gold. Russia's selling a lot of their oil for gold on the Hong Kong Stock Exchange. So right now, all the countries that aren't picking up oil from Russia, they're giving it the rest of that surplus oil that they're not consuming to Saudi. They're giving it to China. They're selling it to India. They're not giving it, they're selling it, trust me. But what's happening is they're selling it for gold. So to understand what's going on here, since the Bretton Woods Convention, which is something I talked about on my last video, since that convention, they decided that, okay, all commodities, especially oil, are going to be sold in US dollars because the US was the most powerful currency in the world. The dollar was as good as gold during that era. Obviously, it's not now. So what Putin is saying is that, hey, we're going to sell all this stuff. And if right now we're trying to do like a deal with him between the US and the EU, and we're trying to cap every barrel of oil at $60. So Russian oil is at $60. Whole time market is at like, I don't know what it is right now. I could look it up, but it's at like $70, $75 a barrel, maybe even $80 a barrel. So we're lowballing him for the whole sanction thing, but we do need oil. US is having a shortage. EU is especially having a shortage, but it's been a pretty mild winter so far. But we're at a turning point where, hey, we kind of need this oil, even though we placed these sanctions on them. They're one of the largest exporters of oil, so we kind of need them. So what Russia realizes is in the position that they're in, where, hey, the rest of the world needs the oil that they have. So what they're doing is they're saying, hey, well, and again, this is if we push them far enough, Russia will go around and say, hey, well, you know what? We don't want your US dollars. We want it in gold. We want our payment in gold, because that's exactly what they're doing with China. They're selling oil for like a yen petro kind of situation, a petro yen, if you will. So essentially like selling oil for yen that is then backed by gold on the Hong Kong Stock Exchange. So this is really important because if you understand anything about investing, then you want to understand that energy is a really great sector to be in, as well as finance and certain other ones. Not really into consumer discretionary and some of those things, even though they are also part of a balanced portfolio. But that aside, it's really important to understand that we need energy. And a lot of places are at a point where energy is scarce, energy is limited, and it's running out. Also looking at the fact that there's this new Green Deal and all of that's coming out where they're trying to shift to a new type of energy. So I would definitely advise, and it's not financial advice, but from a financial point, but just paying attention to different sectors, different types of energy within the energy sector. So I'm not going to explain what that looks like, but in short, that's what I would say about that. So also, the largest wealth transfers happen during these recessions. Because we have the one in 1980, which is important to pay attention to. We also have the dot-com bubble, right? We had that crash, that era. Then we had the 2008 financial crisis. And then we had 2020, which was just like a flash crash. But it's important to pay attention to whenever these things happen, because this is when you get the best bang for your buck. It's important to not invest in a short time period if you want to see like exponential growth in a portfolio. What's important is waiting, sitting on cash for the right possible times, and then buying into something when the price is low and it's needed. So you're seeing a low price and a large demand. You don't see that every day, but that's exactly what you want to do when doing this. Another thing to get into, not financial advice, if they're talking about gold being used as the exchange method instead of dollars, gold's going to go up because there's a finite amount of gold, and the demand is going to drive the price way up if this happens the way that it might happen. Again, not financial advice. Price is already kind of higher than it's been in recent times. It was in the low 1600s, it was like 1620s, and I shot up to 1700, so it's definitely on its way up. So before I get into a bigger gold position, I'm definitely waiting for that price to go down some, but it might not. See, that's the thing. So I already have some, so there's a good ratio to pay attention to. And silver is also another good one of those things. I'm really bullish on metals and God's money. So that being said, hopefully you took some value from this, because again, emphasis on the largest wealth transfers happen during times of recession. So if you're paying attention, position yourself, or you're going to miss it. More light, more love, Rastafari, more blessings. Stay safe. Until next time.